Most people think Elon Musk takes insane risks, putting almost all of his PayPal money into Tesla, into SpaceX, companies that were burning cash, failing rockets, and weeks away from collapse. That looks reckless. But here's the part nobody sees. There's a hidden rule behind every decision he makes, a pattern. And if you understood that pattern, you'd realize something uncomfortable. Most people are actually taking worse risks every single day, just in a way that feels safe, because the biggest financial risk doesn't feel like risk at all. It looks like a steady paycheck. It looks like playing it safe. It looks like waiting. And that's exactly why it works. Today I'm going to show you Elon Musk's actual risk formula, not the headlines, not the hype, the underlying logic behind how he decides when to go all in, why he's willing to risk so much when everyone else hesitates, and how those decisions keep leading to outsized wins. We'll break down how he evaluates risk differently than most people, how he structures his bets so the upside massively outweighs the downside, and the exact conditions that make him go all in. And more importantly, how you can apply the same thinking to your own financial decisions without needing millions of dollars and without being Elon Musk. By the end of this video, you'll have a simple, repeatable framework for thinking about risk, and you'll start seeing everyday decisions very differently. My name is John, and I spend way too much time thinking about how people make financial decisions and why most of them don't work. If you're someone who's trying to build wealth but feels stuck between playing it safe and taking bigger risks, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Now let's start with the first thing Elon understands about risk that most people completely miss. Here's the thing. Most people define risk in a very narrow way. They think risk means losing money, so the goal becomes simple. Avoid loss at all costs. Keep your money in a savings account. Don't invest too aggressively. Don't make big moves. Don't mess it up. On the surface, that sounds responsible, but it completely ignores a different kind of risk. The risk of missing something much bigger. Because real risk isn't just losing money. It's missing asymmetric opportunities. Opportunities where the upside is dramatically larger than the downside. And this is exactly where Elon Musk thinks differently. After PayPal was sold, Elon walked away with roughly $180 million. Most people, at that point, would shift into protection mode, diversify, lock it in, live comfortably. Instead, Elon did something that looks almost irrational. He took about $100 million and put it into SpaceX, around $70 million into Tesla, and another portion into Solar City. At one point, he was nearly out of cash. Now, from a traditional perspective, that looks like extreme risk. But from Elon's perspective, he wasn't asking, "Can I lose this money?" He was asking, "If this works, how big can it get?" That's a completely different question, and it leads to completely different decisions. Because if one of those companies succeeded, not all of them, just one, the upside wasn't 2 times or 3 times. It was life-changing, industry-changing, almost unlimited. This is where it gets interesting. Most people are so focused on avoiding small losses, they never position themselves for outsized gains. They optimize for not losing, instead of optimizing for winning. Look, this is the foundation of how Elon Musk approaches risk. He's not trying to avoid losing. He's trying to structure situations where the downside is limited and the upside is massive. That's asymmetric risk. Here's a simple way to think about it. If you had a bet where you could lose $1, but you could gain $10, you don't need to be right very often to come out ahead. Even if you're wrong most of the time, 1 or 2 wins can more than cover the losses. So logically, you would take that bet again and again and again. Now apply that to Elon. In the early days of SpaceX, failure wasn't just possible, it was expected. The first 3 launches failed. Rockets exploded. Money was disappearing fast. From the outside, it looked like he was just burning through cash on something that clearly wasn't working. But Elon wasn't evaluating it based on short-term outcomes. He was looking at the scale of success. If SpaceX worked, even partially, it wouldn't just be another aerospace company. It could dramatically reduce the cost of launching rockets. It could win government contracts. It could dominate an entire industry that had very little competition. That's not a small upside. That's a massive, almost unlimited upside. And when you compare that to the downside, losing the money he invested, the equation starts to make sense. Because even if multiple attempts fail, one success changes everything. This is exactly how venture capital works. Investors expect most startups to fail, but they're not trying to win every time. They're trying to win big once. One company can return 10 times, 50 times, even 100 times, and cover all the other losses. Elon applied that same logic to his own decisions. He didn't need every company to succeed. He needed one to work at a high level, and that's a completely different way of thinking about risk. Here's what most people don't realize. They focus almost entirely on the downside. They ask, what if I lose money? What if this doesn't work? But they rarely ask the more important question, what if this works? And it works big. And when you ignore that side of the equation, you end up avoiding the very opportunities that actually create wealth. Now, this is where Elon separates himself even further, because he's not just taking different risks, he's thinking from a completely different starting point. He doesn't ask, what do people usually do? He asks, what is actually true? That's first principles thinking, breaking something down to its most basic components, and rebuilding it from there. Take rockets. For decades, the assumption was simple. Rockets are expensive. That's just how it is. So companies operated within that assumption. They optimized around it, but they never questioned it. Elon did. He asked, why are rockets expensive? When you strip it down, rockets are made from raw materials, aluminum, titanium, carbon fiber, and when he looked at the actual cost of those materials, it was only a small percentage of the final price. So instead of accepting the industry standard, he rebuilt the process. Design in-house, manufacture differently, control the supply chain. That's how SpaceX drastically reduced launch costs. Now bring that thinking into your own financial life. Most people operate on inherited beliefs. Investing is risky. Saving is safe. Real estate is expensive. You need a high income to build wealth. But those are surface-level assumptions. Elon's version of that conversation would be, compared to what? Is investing in assets that historically grow over time actually riskier than holding cash that loses purchasing power every single year? Is relying entirely on a salary, which can stop at any moment, actually safer than building something that could grow beyond your time? And this is where people get this wrong. They treat safe and risky as fixed categories, but in reality, they're relative. Saving money in a low-yield account feels safe until you account for inflation quietly reducing its value. Avoiding opportunities feels responsible until you realize what you gave up over 10 or 20 years. First principles thinking forces you to ask better questions. Not, what do people usually do? But what actually makes sense when you break this down? And once you start thinking that way, a lot of safe decisions start to look a lot more dangerous, and a lot of risky decisions start to look a lot more logical. Now, this is one of the most misunderstood parts of Elon's strategy. He doesn't diversify early. He concentrates. When his conviction is high, he goes all in. After PayPal was sold, Elon walked away with roughly $180 million. At that point, the standard advice would be obvious. Diversify, protect the capital, spread the risk. Instead, Elon did the opposite. He put around $100 million into SpaceX, about $70 million into Tesla, and roughly $20 million into SolarCity. That's essentially his entire net worth, tied up in a few extremely risky companies. At one point, he was borrowing money just to cover personal expenses. From the outside, that looks reckless. But again, he wasn't making random bets. He had deep conviction in those industries: electric vehicles, space, energy. He understood the problems. He believed in the long-term outcomes, and he was willing to commit fully. Now compare that to how most people approach money. They diversify immediately, a little in savings, a little in stocks, a little in something else, which feels safe. But the trade-off is this: you reduce downside, but you also limit upside, because diversification is designed to protect wealth, not build it aggressively. And this is the key distinction. Concentration builds wealth. Diversification preserves it. Elon wasn't trying to preserve wealth yet. He was still in the phase of building it, and that requires a different strategy. Now, you might be thinking, that sounds insanely risky. And it is, if you don't understand what you're doing. This only works under specific conditions. High conviction. You deeply understand what you're investing in. Deep involvement. You're not just a passive observer. And a long-term horizon. You're willing to go through volatility, setbacks, even near failure. Without those, concentration can destroy you. But with them, it can accelerate everything. And this is where people get this wrong. They apply safe strategies too early. They try to preserve wealth before they've actually built any. And as a result, they stay stuck in slow growth, never taking the kind of bets that actually move the needle. Now let's look at the opposite. Let's say someone decides to play it completely safe. They save $10,000 per year. They keep it in something low risk, maybe earning around 2 to 3%. That sounds responsible. That sounds like what you're supposed to do. But now let's actually look at the math. If you save $10,000 per year at 3% for 20 years, you end up with roughly $270,000. That doesn't look bad at first. You saved consistently. You didn't take big risks. You built something. But now compare that to a different scenario. Same $10,000 per year, but instead of 3%, you earn closer to 10%, which historically is in line with long-term stock market returns. Now you're looking at over $630,000. Same person, same discipline, same savings. The only difference is how the money was used. And the gap isn't small, it's more than double. This is the part nobody talks about. The safe path isn't neutral. It has a cost, a hidden cost, because while you're avoiding volatility, you're also giving up compounding at a higher rate. You're avoiding downside, but you're also avoiding upside. And over time, that trade-off becomes massive. Now, this doesn't mean you should take reckless risks. That's not the point. The point is that avoiding risk entirely is a risk in itself. A slow, quiet one. One that doesn't feel dangerous day to day, but shows up years later in the form of missed opportunities. And once you see it this way, playing it safe starts to look very different. Now, this is another pattern you see over and over with Elon. He doesn't lock in wins early. Most people think the goal is to make money and then protect it. Elon treats money differently. He treats it as fuel. After PayPal, he could have retired comfortably for life. Instead, he took that money and poured it right back into Tesla, SpaceX, and SolarCity. And even after those companies started gaining traction, he kept reinvesting. Tesla nearly went bankrupt multiple times, and he continued putting more money in. This wasn't about securing comfort. It was about accelerating growth. And during those early years, he wasn't living like a billionaire. He was sleeping in factories, borrowing money at times, keeping expenses relatively low compared to his net worth. Now compare that to how most people behave. You get a raise, your lifestyle goes up. You make more money, your expenses follow. You have a financial win, you reward yourself. And that feels normal. But what it does is interrupt compounding. Instead of letting capital grow, you convert it into consumption. This is the difference between lifestyle inflation and capital compounding. Lifestyle inflation means your life gets more expensive as your income increases. Capital compounding means your money keeps working and growing over time. Elon consistently chose compounding over comfort, at least in the phases where it mattered most. And this is where people get this wrong. They start upgrading their lifestyle too early, before their investments have had time to scale, before their income is truly stable, before compounding has done its job. And as a result, they slow down the very process that could have created long-term freedom. Because the real power isn't just in making money, it's in what you do with it after you make it. Now, this is the part that looks the most contradictory, because Elon appears extremely risky, but underneath that, he's constantly protecting one thing: survival. During Tesla's hardest periods, the company was weeks away from running out of money. SpaceX had multiple failed launches. Cash was disappearing fast. At one point, Elon was splitting his remaining money between both companies, knowing that if one failed, the other might still survive. He borrowed money to keep things going. He cut costs aggressively. He slept on the factory floor instead of going home. That doesn't look like someone being reckless. That looks like someone doing everything possible to extend the runway. Because here's the real rule. You don't need to win immediately. You need to stay in the game long enough to eventually win. And this is where people misunderstand risk. They think risk is about bold moves, but a lot of the time, it's about endurance. If you run out of money, run out of time, or quit too early, the upside never has a chance to materialize. Now watch what happens when you combine this with everything we've talked about. Asymmetric bets, high conviction, reinvesting gains. If you can stay alive long enough while those play out, you don't need everything to go right. You just need one thing to work. And that's exactly how Elon has been able to turn near-failure situations into massive outcomes. Now, let's bring this down to your level, because the goal isn't to become Elon Musk. It's to think the way he thinks about risk and apply that to your own decisions. Here's how to do that, step by step. Step 1. Calculate asymmetry. Before you make any financial decision, ask 2 simple questions. What's my downside? And what's my upside? Be specific. If you invest time into a new skill, what's the worst-case outcome? Maybe you waste a few months. But what's the upside? A higher-paying job, a new income stream, more leverage. That's asymmetric. This is exactly how Elon looked at SpaceX. Yes, he could lose money, but if it worked, it could change everything. Step 2. Take bigger, smart bets. Early in your life or career is when asymmetry matters most, because your downside is naturally limited. You don't have massive obligations yet. You have time to recover. You have the ability to try again. So this is when you take bigger bets, learning valuable skills, switching careers, starting something on the side, investing consistently. Elon didn't diversify early. He focused intensely on a few high-conviction bets, and that focus is what created scale. Step 3. Stop overvaluing safety. This is a big one. A lot of what feels safe isn't. Keeping money in low-yield accounts feels secure, but inflation is quietly reducing its value every year. Avoiding investments feels responsible, but the opportunity cost over 10, 20, 30 years is massive. Elon constantly asks, compared to what? And once you start asking that question, you realize that safe and risky are relative, not absolute. Step 4. Reinvest wins. When something works, don't immediately cash out into lifestyle upgrades. Reinvest it. Increase your investments. Build more assets. Let compounding do its job. Elon didn't stop after PayPal. He used that win to fuel the next level. Most people do the opposite. They convert financial progress into consumption and slow themselves down. Step 5. Extend your runway. Finally, protect your ability to stay in the game. Lower your fixed expenses. Avoid unnecessary financial pressure. Give yourself flexibility, because the longer you can operate, the more chances you have for something to work. Elon understood this deeply. Even while taking massive risks, he was constantly trying to extend survival, cutting costs, borrowing when needed, doing whatever it took to keep going. And when you combine all of this, asymmetric bets, focused effort, reinvestment, and long-term survival, you don't need everything to work. You just need one thing to work really well, and that's the formula. Now, if you zoom out, there are really 2 paths. One is the safe path. You avoid risk. You make careful decisions. You stay consistent. And over time, things improve, but slowly. You stay stable, but also limited. No big losses, but no big breakthroughs either. The other path looks different. You still think carefully, but you start taking calculated risks. You look for asymmetry. You take smarter bets. You reinvest your wins. And over time, something changes. You create optionality, more income options, more flexibility, more control over your time. That's the real goal. It's not about becoming Elon Musk. It's about thinking differently about risk and making decisions that actually move your life forward. So here's what I want you to do. Comment one decision you're currently avoiding because it feels risky, and start looking at it through this framework instead. My name is John, and I'm not a financial advisor. This video is for educational purposes only. Always do your own research and make financial decisions based on your individual situation. Everything discussed here is meant to help you think differently about risk and decision-making, not to provide specific investment advice. Your financial situation is unique, and what works in one case may not apply in another.